Enbridge could be a great company to hold in the portfolio, especially for those who love high-yielding, safe dividends. This company yields nearly 8%. We're going to take a look at the historical performance of Enbridge. We're going to take a look at their income statement, look at their top-line revenue as well as their bottom-line net income growth. We'll also analyse the health of the company, their total cash versus their total debt. We'll also see how well they're performing in the industry as well as their own performance over the last 5 years. We'll also look to the institutions to see if they are buying or selling this quarter on quarter. We'll run through a quick screener on insider buys, insider sells. We'll also talk about the dividend safety, run through some important financial metrics for this company, and we'll also touch upon their earnings, which they did just release today. And as always, we will get them through the valuation screener, getting to our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. So let's take a look at the historical performance. They are down 14% over the last year. Over the last 10 years, they're down 22%. Bear in mind, whilst it doesn't include those dividends reinvested, not the greatest performance, and their all-time highs a long time ago, 2015, at around $54, and they are trading towards the mid to lower end of the 52-week range with a PE around 16. Now let's look towards their earnings. Now we can see they reported record 2023 financial results as well as reaffirming their 2024 outlook. Let's have a quick look at some of the numbers. So what we can see here, their earnings, $5.8 billion, which looked very strong, up from $2.6 in 2022, so that is nice to note. Adjusted earnings stable, $5.7 billion, a small decrease as we can see here from the prior year. Earnings before interest, tax, depreciation, amortization up 6%. Cash flow, very important, we see here for their operating activities, $14.2 billion in cash compared to the $11.2 in 2022. Distributable cash flow, very important for these type of companies, up $0.3 billion to $11.3. And for those that love to see those dividend increases, we'll touch upon it shortly, but they did increase it by 3.1%, as well as the debt to EBITDA metric improving. Again, we'll look at this in more detail. So not too bad, pretty decent. Let's take a look at the numbers in terms of the revenue and bottom line net income. Well, total revenue, $34 billion. We look to see 3 to 7% growth year on year. 39 reported in 2022, trailing 12 months expecting that around 34 billion. So look, it has increased over the last 5 years, including 2023, a small drop. On a more granular level, what we can see, 34 billion increased to 2019 before decreasing and then increasing and increasing again before another drop. It comes down to the volatility and cyclicality of the industry. And the bottom line net income, what we can see, it has increased over the last 5 years, 2.1 billion to 2.2, 2023 around 2.5. But again, the volatility and cyclicality does show from the year on year where it does tend to increase and then decrease. Very quick health check, total cash versus total debt, 396 million in 2018, 2.2 billion in the latest report. So they do hold a lot of cash, in fact significantly more than they did 5 years ago. Quick health check, total cash versus total debt, so we need to look at the debt as well. 47.7 billion in 2018, 57 billion in the latest report. So they are, although holding more cash, their total debt has increased, and that will be important when we do come to analyse their net debt to EBITDA metric. Quick look then at some others in the oil and gas storage and transportation. We have EPD, Energy Transfer, and a few others. Over the last year, ENB down just under 10%, one of the worst performing. That includes those dividends reinvested. Over the last 5 years, we can see, again, one of the worst, only up 28%. So again, do bear in mind they haven't had the greatest track record over the last 5 years. But as always, past performance isn't an indicator of future performance. Institutional ownership, 48%. We do note 2.7 billion worth of outflows by these institutions over the last 12 months. During the same period, a lot more buying, 9.2 billion, so we can clearly see that the institutions do like this company. Q1, Q2, Q3 and Q4 of 2023, we see more buying than selling by these institutions. But always remember, do not copy what the institutions do. Do your own due diligence. Insider trading, we run it through the screener, a minimum 100 shares over the last year. There is nothing to note here for transparency, but we are showing it just so you're aware. So let's jump into the dividend safety. Let's talk about the financial metrics. Dividend safety score of 70, it looks to be safe. Market cap 73 billion, a large cap company. In terms of the latest recessionary metrics, well, the last recession, 07-09, they increased the dividend. Below average growth, negative 21% versus the S&P's negative 12%. But we do also see they did outperform the S&P, negative 23% return versus the S&P's negative 55%. Now, they have had an increase just this day at 3%, but we do see their latest before today in November 2023, 3.1%. Last 5 years, 7% on average. Last 20 years, 12%. Double digits over the last 20 years is always very nice to see. They are a dividend aristocrat. They have increased those dividends for 25 years or more. And we do see they've been paying dividends for the last 70 years without a reduction. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average, 7.91 versus 6.77. So we have our first sign of undervaluation. Please bear in mind, we're not looking at any of these models in isolation. We'll draw our conclusions towards the end. Forward P to DCF, 8.6, again below the 5-year average of 9.9. Another undervaluation signal, but we do note the energy sector PDCF is slightly lower at 7.3. So let's take a look at the payout ratios. Now, for companies in the pipeline industry, we do focus on the DCF payout ratio. Below 70% is our target. We can see consistently below that. 2022 and 2023 expected 63%. 2024 a little bit higher, but still below that 70% target. So it does look safe. DCF per share, well, we can see it has been increasing from 2015, 372 to 552 in 2023, although we do note it is expected to go slightly lower. Nonetheless, it does increase over the longer term, but not as much as maybe you would like. So always bear in mind what type of companies you are looking to invest in. Sales growth, top line, just for consistency, we can see double-digit increases for most of the last 10 years, although we see 3 years of the last 11, so including 2023, at negative growth, so you can argue the cyclicality and volatility. But over the long term, nonetheless, 33 billion in 2013, 46 in 2023. In terms of shares outstanding, yes, we love it when companies do share buybacks, but it is very typical of companies in this industry to dilute your position. As we can see here, 817 million shares outstanding in 2013, 2.03 billion in 2023. Now, ROIC, what I quite like to see, 3 to 5% for this industry. What's nice to note, not only is it around that over the last few years, but it has also been increasing, so that is positive, does give us faith when looking at management within our investment thesis. Operating margin, very nice to note, it has been increasing year on year. It is around that 16% that we like to see over the last few years. 2023 coming in at 21%, so no worries so far. Net debt to EBITDA then, we did mention this earlier, earnings before interest, tax, depreciation, amortization. This essentially correlates with the dividend safety as well as balance sheet strength. What we want to see below 4.5 for pipelines. What this signals the number of years it would take the companies to pay off all of their debt net of cash on hand. 2022, 5.06. This isn't great. We don't want to see this, although we know it has started to come down year on year. 2023 expected 4.5. That is very nice to see. Pretty much in line with the maximum we want to see for the pipelines. 2024, they are expecting this to come down even lower to 4.39. So again, no real worries. We see the dividend safety score at 70, the DCF payout as well looking very nice, below 70%. So in terms of their essential dividends, it is looking very good. Now, before we jump into the valuation, just to let you know, today we have released the next edition of the free weekly newsletter, running through insider buying and selling some examples over the last few weeks. As always, if you want to grab a copy completely free, click on the pinned comment below. So let's jump into the valuation of Enbridge. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribing bell so you are continually notified of these videos as they drop. So the first model, Graham's valuation, we have the stock ticker symbol, the earnings per share, long-term growth rate, current yield on AAA corporate bonds, giving an intrinsic value of $26. So we have our first sign of overvaluation. Just bear in mind we're not looking at any of these models in isolation and we'll conclude towards the end. We then have the multiples valuation model, couple of companies in a similar sector and size, average P multiplied by the EPS of Enbridge, and we can see here quite a low intrinsic value, our second signal of overvaluation. We then move on to the third model, the dividend discount model. Now, average growth rate looking very nicely. We have the latest increase at 3%. We've tried to be a lot more conservative, so we have our growth rate of 3% forward looking. This gives an intrinsic value of $56, so we have an undervaluation signal for the first time so far. We then move on to the fourth and final model, the DCF model. where we have the free cash flows year on year, we have the average growth rate forward looking by analyst estimates. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We get our second signal of undervaluation. So in total for Enbridge, we had 2 undervaluation signals, 2 overvaluation. This gives us our intrinsic value for today's episode of $42. And as always, if you do want to grab a copy of the valuation model to get to the intrinsic value, as well as acceptable buy price of companies in your own portfolio or on your watch list, do click on that pinned comment below. Margin of safety then, as always, we start off with 10% if we believe it has a wide moat, strong financial metrics and good forward-looking data. So it is a buy up to $37. At 15%, a buy up to $35. At 20%, we can see it isn't too far off the current trading price. So we see between 15 to 20% margin of safety for Enbridge. In terms of Wall Street and what they forecast, well, they have a price target of $39, upside of 16%. As always, let me know your thoughts in the comments below. Are you adding to this company, which does have a fairly nice, attractive starting yield over 7%? It does also look to have some upside, and the earnings were very positive. Let me know your thoughts. I'm interested to hear for today's episode of Enbridge. As always, if you enjoyed the content, smash that like button. I'll see you all on the next one, and for now, take care.